Hi everyone, this is Paul and I'm back with my video series Darn Good Advice. Today's Darn Good Advice is on life insurance. So life insurance certainly has a place within your financial blueprint. I do not endorse life insurance that is marketed and sold as an investment vehicle or as a wealth hack or secrets of the true wealthy. I have another Darn Good Advice video explaining that. I will not get into that here. What I will get into is what is life insurance? Who needs it? When do you need it? How much do you need? How long does it need to last? And where do you go to get it? So let's understand that all insurance policies are simply a trade. You are guaranteed a loss today to protect you from a much larger loss in the future when some catastrophic event takes place. Maybe it's totaling your car and injuring somebody, maybe it's your house burning down, or in the event of life insurance, it's when you pass away and all your survivors are not able to profit from your paycheck. So who needs life insurance? Well, the reality is if there's anyone that relies upon your income, you have what are called dependents. And dependents may be obviously like a spouse or children, but what if you have parents that are expecting you to be around in their elder years to take care of them? You need to consider what is impacted when you are no longer here and your paycheck no longer exists. So here are a few scenarios just to show how complex this landscape really is. Let's start with a young single person. This person has no direct dependents that we would consider, but they do have the expense of a funeral. They may have bought a house or a car, and they may need uh, to have some type of provision for elder care. Now, keep in mind one word about debts. Debts go against your estate. So when you pass away, before you can collect the insurance proceeds, you have to make whole any outstanding debts, with the exception of student loans. Student loans will actually go away when you pass away. But this person who is single, they have a short term need and they can be taken care of rather quickly. Newlywed couples, for example, live in a very expensive point in time. First of all, they've probably entered a lifestyle that requires both of their paychecks to survive. They may have taken on the expense of a new home, perhaps even a home that they bought with expectations of doing modifications, repairs, etc. in the future in order to make it their dream home or even make it livable. They may have future plans for college savings for their children, etc. And consider this, without your spouse, the survivor may need to go back to college or go to trade school so that they can take on and master a better paying career. All of these expenses have to be considered. But one thing that does change the dynamic a little is that younger people have a high likelihood that they will remarry. And if you did have young children, there's a moderate time horizon when you would want to provide for them some type of financial assistance in the form of a trust or perhaps even college savings. An older couple may have reached the point where remarrying is highly unlikely. They may just finish out their life surrounded by friends and family and other support groups. They still have a list of expenses and debts that need to be taken care of. So they too are going to have a relatively long term need for lost income to be replenished. And then we start getting to the phase of life where we become our empty nesters. So by now, our retirement savings are starting to kick in, the kids are starting to move out, the house is at or near being paid off. Hopefully, you have your debts under control. And these folks would have a medium to long term need for their survivor. And then come our elders, which we would consider to be at this point self insured. At this point in your life, your house is paid off, the cars are paid off, the kids have moved out, the retirement plan is rather high, you're starting to receive Social Security, your need for life insurance shrinks to zero. So there's virtually little or no need for older people to have a life insurance policy. And as you can see from these scenarios and 1,000 points of light in between them all, you have to do some serious consideration to understand who, when, where, how much, and how long your expenses will need to be covered in the event that one of you dies. So how much do you need and how long do you need it? Well, that is the difference between a short-term and a long-term solution. Short-term solutions are rather easy. We add up all of our outstanding debts, we add up all of our funeral expenses, etc., and we get a face value that is great enough to cover all of our expenses. And when the proceeds are paid out, the executor of our estate can make sure that all the bills get paid and the situation is over and done with. Long-term solutions are a little bit more tricky. Remember that your paycheck is necessary on a longer ongoing basis. That means finding a way to generate the same amount of money year after year after year as when you were earning a paycheck. The mathematical formula is rather simple. You take your yearly expenses, divide it by a reliable rate of return to get the death benefit that's required for this scenario to play out. Remember that you are investing so that you have a perpetual paycheck replenishment. If you think that $100,000 is an adequate amount to cover somebody, and you have a $50,000 a year salary, you've only protected your family for 2 years. So if you have young children or a spouse that needs to be retrained in order to go get a career, your children are too young to, now they have to have daycare expenses added into the household budget. $100,000 may sound like a lot of money until you realize how quickly that can disappear. So let's do the math, right? Predictable returns also happen to be lower returns, right? So predictable, reliable returns that are consistent year after year, because that's when your paycheck is needed, consistently year after year after year, will not be the 10%, 12% growth in the S&P 500 market. It's going to be something from the fixed income side of the house, which is your CDs, your bonds, your stocks that pay a steady dividend, and those are going to be typically 4 to 5% growth reliable every year. A quick survey of what does it take at a minimum for your surviving uh, loved one to have their expenses covered shows that it could be as much as $41,800 a year. Divide that by the 5% that they can expect to get consistently and reliably, and that means you're not insuring yourself for $100,000. You are insuring yourself for $836,000, and when that amount is paid out to your surviving family or friend, that amount gets invested and you live forever off of the annual earnings. Now, that is one end of the spectrum. Somewhere else in the middle of the spectrum would be as you get older and your expenses go down, as the house gets paid off, as the kids move out, you can consider spending down the principal. So you have to do a little bit of math to make sure that in the short term, your paycheck has been accounted for. But you may not need a model that is generating your lost paycheck forever. Okay, so got to do a little bit of math to keep up with that. So let's review now the types of policies that you can buy as you pick up the phone and call those agents. What are you going to be offered? Well, first of all, most of us have some kind of coverage through our benefit package at work. The danger here, although it is cheaper because you're getting group rates, is that your insurance, whether it's health insurance or life insurance, it ends when your employment ends. So you may need to pick up a policy outside of the benefits that you have at work. The other type of policy that's out there is whole life, universal life, indexed universal life. These are the policies that have some type of investment component to them. The sales pitches are very slick, and in some ways, they may end up being an okay buy, meaning that they have a flat price for as long as it takes for the policy to be paid up, which could be 15 to 25 years, and then you never have to pay again. The problem is that those monthly premiums are 150 to 500% to 1500% higher than those of term insurance. So it's an awful lot of money coming out of your pocket every month for a whole life policy. But if you are a person who has a questionable medical history in your family and you're not sure that you will be insurable later on, you should get one of these policies early. And the same would hold true for term insurance. Term insurance is very simple. It is basic, straight up insurance. There's no investment component. There's no such thing as ever being paid up. You simply pay your premiums year after year, month after month, and you are covered as long as you're paying. Your premiums will go up every year that you get closer to death, unless you ask for something called level premium terms. So you will overpay the first few years so that the payment stays the same, including in the later years. So it's kind of like a seesaw, right? You're paying a steady rate, overpaying at the front end, not overpaying at the back end, so that you can have a predictable amount of money added and subtracted from your budget each month. And again, if you're in a situation where you may not be insurable in the future, again, family health issues are the first thing that come to mind. Please get your insurance policies as early as possible, because all insurance policies that I know of are renewable. So as long as you're covered today, they will continue to renew your policy each time it's up for renewal. You just have to pay the premiums. So folks, we threw a lot of information at you in a short amount of time. There's much to consider when making sure that your departure from this planet is being managed as responsibly as possible. Again, no amount of money mends a broken heart, but the people that you leave behind will be impacted, and finances are something that is in your control through life insurance. And that is some darn good advice on life insurance. Thanks for watching, like and subscribe, and I will see you in the next video.